Hey everybody, how's it going? Welcome to a Capital Hungry Monday market analysis live stream. How's everybody doing this evening, afternoon, night, depending where you are in the world? So through this live stream, just over the next 30 to 60 minutes, depending how long it takes to explain the fundamentals, technicals, and my viewpoint across these various trading instruments, we're going to be breaking down some of the key economic events in focus in terms of economic reports for the following daily period, key fundamental points in focus, technical analysis and trade ideas on gold, GBP JPY, GBP USD, EURUSD, USD Cad, and US30. Okay? For anybody who has any questions about Capital Hungry resources, make sure you check out all of the links in the description. Drop a like, subscribe, turn post notifications on, and let's just hop right into it, shall we? Okay, so some key recent fundamental points that I want you guys to keep in the back of your mind as we go through this webinar and breakdown is understanding that during their interest rate statements, the Bank of England as well as the Federal Reserve threw a curveball, and what I mean by curveball is going against the market expectations in terms of being hawkish in terms of both central banks showing more of a hawkish side towards economic recovery and showing more aggression towards tapering in terms of the Feds and the Bank of England in terms of hiking the interest rates, right? We can see instead with the last FOMC statement and the last Bank of England statement, the Feds to begin with pretty much copied and pasted the September FOMC, and we're still more focused on economic risks, COVID risks, supply chain risks and bottlenecks, and we're still very pessimistic towards economic recovery and did not bring anything new to the table that wasn't already priced in from the previous Fed statement by investors in the market, right? So please keep this in mind in the back of your head, as it's going to be very relevant when we're breaking down gold and some of the economic data that we had follow up the weeks after FOMC and the reason why gold has been so bullish. And for anybody who's been following the last market update webinar where we did the Fed interest rate prep work, you would understand that that was the curveball scenario we were laying out, where the Feds were actually going to be not as aggressive towards tapering, stay away from talking about interest rate hikes, be very pessimistic towards economic recovery, and talk about supply chain risks and so forth. And obviously that would in turn bring more market fear and show that they're still going to be keeping an accommodative stance towards their monetary policy and keep the stock markets and other assets pumping accordingly to squeeze out those gains until the end of the year and into the Christmas rally, right? So that's something very key to understand, is that the Feds and Bank of England were still dovish towards economic growth and avoided rate hikes or aggressive tapering at their last statement releases. This obviously led to a fundamental bearish impacting factor on GBP, which we have been playing to our advantage, and that was also in the YouTube short I posted 11 days ago that you could have been taking advantage of as well. A singular 1 minute long video breaking down the no rate hike, the impact of Bank of England, and how to play that sentiment, and we've been bearish on GJ and GU since. But anyways, US dollar bulls on the higher time frame due to the historical repetition and order flow are back to the table, and global equity markets are still rallying. So now back to the first point. When the Bank of England was still dovish towards the economic recovery and did not hike interest rates, this was a bearish impacting factor for the currency, as it devalues or it keeps the currency at a devalued state on the global scale against other crosses and in other currency pairs, right? But it's a bullish factor for the UK equity markets because those smart money investors are just riding the continued support and wave of that central bank's respective stimulus for the UK, right? It was the same thing when we saw the Feds throw the curveball. We can see gold went extremely bullish as they were talking about economic fear and risks that still remain regarding supply chain issues, Delta variant, labor market not being at maximum employment yet, and so forth. But the equity market still continued bullish because the investors translate that as the central banks are still going to keep supporting the economy, which means still going to keep pumping the markets. So global equity markets are still very bullish across the board, which we're going to look at that all now. So we're still playing that optimistic sentiment when we're trading any of our equity markets and indexes here around the globe here. Mainly we've been focusing on US North American equities and UK and Euro to give us more of a sentiment reading just from those specific zones. But even like Asia Pac in terms of like Japan, Australia, still extremely bullish, sitting at high points or just ranging at highs. So stock market buyers are still continuing to ride that central bank support coming into the potential holiday season, where we usually see the historical repetition of what they call the Christmas rally going into the end of the year before seeing potential order flow setups at the start of the new year. But anyways, that's more macro talk. In terms of market sentiment, investors are still optimistic, riding the greed trains on global equity markets. The volatility index is flat. The Japanese yen is still bearish and flat. It's only the US dollar individually that's still holding a lot of strength due to the continued pricing in of potential future rate hikes and the historical repetition you can see here. When you're looking at this previous price sensitivity area and run from 2015 to current time, you can see the exact same repetition here from the supply zone and this very strong institutional low demand zone at 90. You have a very extended bearish rally down to this area, and then you have an upside correction with the same thing that happened with the US dollar, obviously having a massive increase in money supply when the Feds increased the money supply to stimulate the economy. So obviously that means an oversupply on the dollar. Also a decreased demand in the dollar, as you have most of the demand going into the equity markets and other assets. So for that year and a half, when the Feds exponentially increased the US money supply and we had that drop, you can see it was very strong bearish market structure with sellers in control until we came to this very specific demand zone and collected buy orders here, which you can see the exhaustion by sellers, which we had analyzed based on the technical double bottom, but just showing us the shift of buyers coming back into strength. And then we're seeing this very similar potential repetition of these aggressive market waves as we're potentially going to be making our way to the upside with future rate hikes and obviously tapering and so forth to continue. So with the further pricing in of tapering and getting closer and closer to obviously future rate hikes, as the economy is in that situation, otherwise there's going to be a high chance of reaching hyperinflation states, which that is obviously never good. This is a specific situation where both the US dollar and gold are bullish, right? The reason being because for the time being, even though tapering started, which is further pricing in for the dollar individually, the individual currency, gold is, you have to understand, is a precious metal, obviously traded on the global scale like anything else, and is heavily influenced based on inflation. So global inflation is still extremely high, especially US inflation, as we saw last week with the CPI Consumer Price Index. So gold has been very bullish, riding still that heavy inflation as investors hedge inflation risks by pooling into gold. And we're going to be talking about that in a minute as well. But in terms of market sentiment, in the short term, when we do our analysis on the currency pairs, we are going to be looking to take advantage of the US dollar strength when we're looking to trade GU, EURUSD, or USD Cad, as obviously the dollar is the world's reserve currency and holds a lot of value. And the Japanese yen is relatively flat, and GJ does have the potential in terms of market structure to have a bullish pullback to retest better sell points, which I'm going to be discussing now when we go into the individual analysis. But first, let's start with gold. So, ever since the start of the month, mainly ever since the last FOMC, the November FOMC, when the Feds didn't bring anything new to the table and didn't discuss anything optimistic towards economic recovery, and still were more on the pessimistic dovish side, you can see that even when you look at the statement releases, it was pretty much a copy and paste of the September FOMC, right? So the tapering and all that, which was already known in terms of the schedule of tapering, as well as the amount the tapering would start by in terms of decreasing the asset purchase per month on the treasuries and mortgage-backed security side, all that was already well known in the September FOMC and was priced in accordingly then by investors ahead of time and during that month, right? So when they brought nothing new to the table and through that curveball scenario we were talking about, and instead talked about economic risks regarding supply chain issues and COVID risks regarding the Delta variant, as well as not seeing maximum employment, we can see we had this initial reversal here and continuation up the next daily candle to correct this downside move and start to create some very solid bullish market structure. As the Feds through that curveball of primarily still keeping the economy in an accommodative state in terms of their monetary policy, this obviously led to stock market buyers continuing to the upside, but this is also a bullish fundamental impacting factor on the on gold against the dollar, XAUUSD, and we had that Fed sentiment move here, that following daily candle impulsive move, an order block and intraday consolidation zone created with more buy orders being collected, breaking above that breaking above this 1810s resistance zone and continuing some very strong bullish market structure. After collecting more buyer order flow, the following fundamental catalyst to have us break so bullish was last week, which was the extremely high US CPI. Now remember, fundamentally, when inflation risks are increasing and high, investors hedge against those inflation risks by pooling into a precious metal commodity such as gold. So with that US CPI, the yearly and monthly being so high, both figures above forecast as well as prior figures, it just continued to add on to the Fed sentiment and then also have this monster bullish push on gold that we played accordingly and was also discussed in the Fed rate prep webinar. So now we're still going to be looking to extend this intraday gold bullish market structure overall, because all we're really seeing happening here is we have multiple fundamental catalysts still for gold bulls, with obviously inflation still being high across the board. And when we look at economic data, you're going to see that later in the week, we have inflation figures from multiple countries such as the Eurozone with France and Italy. We have UK CPI and inflation figures on November 17th. Same thing with Eurozone, Canada CPI as well. And pretty much global CPI is going to be high across the board. So this is all still going to be potential bullish fundamental factors to extend the gold rally when we're looking at it on the higher time frame here. So when we're looking at gold on the higher time frame on the weekly chart, you can see we still haven't broken that significant demand zone at 1680s. Started to create some stronger intraday bullish market structure while finally breaking above this key supply area that we were struggling to break above around the 1830s, with now potential range. If we continue this bullish price action and inflation is still high across the board, that give or take getting some potential pullbacks, we're going to be making our way up to retest this price sensitivity area into the 1900s and correct this downside move, riding the Fed FOMC sentiment as well as increased global economic inflation and playing the bullish intraday market structure and very strong bullish price action, when you can see consecutive bullish candles and much larger bullish candles signaling a lot more buyer order flow dominating in gold on the intraday time frames, with minor bearish candles just being pullbacks or potential consolidation zones on the intraday time frames, and just continuing our way to the upside. Now, the only thing showing a little bit of struggle there are these intraday rejections at 1870, 1868. But overall, bullish market structure is still well intact, and regardless of the trend line, which is just a visual representation of the bullish market structure, we're still going to be maintaining the bullish market structure as long as we hold above 1844s, where 1844 was the last price sensitivity area where we had buyers extend into a high, peak a new intraday high, take some profit out of the market and create this pullback phase before extending back to these highs and having multiple failures to break below there. So in terms of gold trade ideas, I'm primarily playing the bullish side, with the green boxes being buy areas at these higher time frame key levels, or safely taking the buys with intraday candle closures above 1867 and 1868. I would only personally be looking for any sells on gold if we have any fundamental market optimism that would decrease the demand of gold on the intraday time frames, and I would need a technical break below that significant price point that's maintaining the integrity of the bullish market structure, which is below 1844. Otherwise, above that, I'm just primarily looking for pullback buys or breakout buys at these significant price points of interest. Okay, keeping in mind that in terms of economic data, we don't have much in terms of US stuff until tomorrow morning, which is the retail sales. But overnight, we have UK employment data with the claim out, count change, and unemployment rate at pre-London hours, 2 a.m. Eastern, average week earnings and employment change. We have some CPI figures from France and the Eurozone overall through 2:45 a.m. Eastern till 4 a.m. Eastern. We also have GDP figures from the Eurozone, flash estimates quarterly and yearly at the Asian session close at 5 a.m. Eastern. And then we don't really focus on New Zealand too much. We don't trade too many NZD pairs. But for our Canadian dollar pairs, we have housing start figures at 8:15 just after New York Open. And at 8:30, this is the main focus in terms of potentially keeping our gold bullish sentiment. We would need this collection of US data to primarily be on the more negative side and showing us a decrease in economic activity in terms of retail sales, as well as a potential drop in the industrial production, or at least not as aggressive of a rebound as they are expecting here. So otherwise, if we see that this data is good, then there is a lot of potential for having rejections at these highs, but I would still only sell if this economic data is good across the board, which I'm expecting it to be a little bit off, more on the neutral monotone side. But if the data is solid across the board, I would still only look for sells below 1844. Because what I would need to validate is that the economic data being potentially good in that scenario holds enough weight by investors and the market makers to break the bullish intraday market structure, which would be validated by breaking below that last higher low price point at 1845. Does that make sense to everybody? Otherwise, I'm playing this. Does that make sense for the gold analysis for everybody? Okay, I'm just going to assume yes. Now, GBP JPY. So, obviously GBP JPY on the higher time frames, on the daily, weekly, etc. is very bullish. But I want to explain to you guys a very, very interesting concept here and why GJ pushed so bullish and we were riding the buys accordingly at the start of the new quarter, October, and why we switched into a bearish bias here and have been bearish since. Okay, so this 149.5 demand zone, if you guys watch my previous market update webinars and so forth, you can see on the higher time frames, very strong demand zone. Okay, at the start of the new quarterly period, we had order flow set up with buy orders being collected right at the start of October, and then this extremely strong rally from 150 to 158 new highs, right? An 800 pip rally in a matter of 2 weeks, But a lot of people who are playing the buys don't fundamentally understand why GBP was so bullish at that time. The one reason was because JPY was obviously flat during that time and has been bearish individually, the Japanese yen, during these times when there's not much demand for it, when most of the demand is in the equity markets by smart money and the investors and market makers, right? But the other reason was that during the start of the new quarter, over one of the weekends, Bank of England's Bailey, as well as other Bank of England speakers, were signaling at rate hikes to come, and were talking about a very optimistic overall tone towards the economy. And investors knew that the following Bank of England statement was only a few weeks after that, coming into November, right? Just a bit after the last Fed rate, the last FOMC. So when the Bank of England speaker and the Bank of England speakers, but mainly Bailey, gave hints at rate hikes towards the next statement release, which was only a few weeks away, and was giving a very optimistic tone towards the economic recovery, we had this extremely strong bullish rally that continued us up to these highs at 158. On the intraday time frames, beautiful bullish intraday price action with investors just pricing in those rumors, buy the rumor, sell the news, right? Legendary terms in Wall Street and just overall in investing. Just the rumors of this Bank of England representative and head, Bailey, and the other speakers talking about potential rate hikes at their next statement release and economic recovery and how the economy is so much more robust than compared to the pandemic state and so forth. We had investors already price that in and ahead of time start seeing a huge inflow of GBP buys. And you saw this across the board, right? So investors priced that in, and we had this very strong bullish rally until we got some exhaustion and buyers taking profit at these intraday highs, right? And then it looked like GJ was going to just do a bit of a pullback phase, and everybody was anticipating it to continue up. But even I was going to potentially say, oh, just based on the price action and market structure, bit of a pullback phase, potentially create a support and continue back up. All the Miami marketers who don't know the fundamentals were like, oh man, what's going on? GJ was so bullish. How come it's not going up anymore? Right? But what happened was the Bank of England, during their statement release, followed suit with the Feds and threw the curveball. They went against the expectations that they previously set in the market that had us so bullish, and did not hike interest rates and were very pessimistic towards economic recovery, talking about supply chain risks, labor market issues, and the exact same thing the Fed said, right? This led to a drop in GBP across the board, as you have an outflow of liquidity in GBP and the short orders enter, but led to UK stock market still continuing bullish, riding the support of the central bank stimulus and so forth, right? So ever since the Bank of England move, if you guys followed the YouTube short I posted 11 days ago, or for anybody in the private chat, we've been in GJ sells since, right? And I do see the potential that you have to understand the reason we were so bullish here was because the Bank of England was giving hints at rate hikes and was very optimistic towards economic recovery, and then here did the complete opposite, went against expectations. It was literally a buy the rumor, sell the actual news type of play, right? We already pre-planned and accepted that because of the central bank prick factor. It's the central banks at the end of the day. You got to understand how they operate like that. You know what I mean? They're corrupt, fucking greedy. They're making their money in the markets as well. You know what I mean? But anyways, so there's a lot of potential that full move we had from the upside can be fully corrected, and GJ can still come right back down to 150.5. But I do see the potential that in the short term, we can have some pullbacks, even if we get deeper intraday pullbacks to 150.4, still maintain the bearish market structure and integrity, and then continue our way back down to these 150 lows. So now let's zoom into the intraday time frames to map out some intraday trade ideas based on the price action, market structure, and sentiment. So you can see very strong impulsive move from the Bank of England. Then we had these solid continuation moves and printed at least new intraday lows. From these new intraday lows printed, you can see just for the start of this week and from the end of last week, we're having a bit of pullback and sellers taking profit, potentially with buyers jumping in to collect us to better sell points to potentially take us right back down to these lows. Right? Because at the end of the day, you have to understand, based on the transactions between buyers and sellers, which in the modern market is just instantaneous with the amount of market participants and so much of it being algorithmic based, right? You have to understand that the market moves in waves. You have these impulsive moves, you have potential corrective phases, which a corrective phase can be usually identified as a technical consolidation zone or a technical pullback in a trend or so forth. But you have to understand these waves and play these waves accordingly. So even though we have this GBP very strong bearish market structure and price action, there is the potential that GJ, even as it's making its potential continuous lows and making its way down, can have these aggressive pullback phases that don't break overall market structure, go to collect sell orders from better price points, and then continue your way down with the technical bearish market structure. Does that make sense for everybody? So in the short term, I do see that if we break above 153.2, we're going to be just mapping out some of this corrective bullish structure here accordingly, right? If we hold above 153 and 153.2, I do see some potential pullback buys on GJ to potentially set up better risk versus reward sells after collecting more sell orders from a more demanded supply zone. But we're just monitoring the market maker movement and waves being created, right? Or the safer sells is if we break below 152.5. Especially in the short term, we do have the Japanese yen softer, and we do have GJ just in this intraday pullback structure as sellers printed new lows. And it's very normal when you understand the behavior of how GJ operates to have some aggressive pullback phases that could run 50, 100, 150 pips, sometimes a lot more than that. For example, just understand these are the trade ideas, but let me just show you guys some examples. It's just the way the pair operates, whether in, like, for example, look at this bearish market structure when we were in a pullback phase. As you still had continuous lows being printed here, you can see as sellers are in control and the overall median price is going down for that extended period of almost 2 months, you still, during some intraday phases, have these aggressive pullbacks that can be 200, 300 pips. And it's not just that. You have to understand, based on your time frames, that these pullbacks can be an entire week long, or 2 weeks long, or 3 weeks out of the month. So even though you're overall in bearish market structure, as an intraday trader or a scalp trader, you have to understand the market waves accordingly and play those waves. You don't want to be selling during these pullback phases, just like you don't want to be buying during the impulsive phases back down to the lows. Right? And it's not just that, it's the same thing on bullish market structure as well. You can see some of these heavy consolidation zones and downside moves that are pullbacks to collect more buy orders and potentially fake out a lot of retail traders, usually new highs being printed as well. But overall, if you don't break the bullish market structure, you still continue your way to the upside. But what you have to understand is during these pullback phases, which are just going against the current trend, in this situation being bullish, you don't want to be buying when GJ is doing that 300 pip bearish pullback and it's lasting a week and you're a scalper or intraday trader. You want to adapt to that market phase and market wave, play those potential short-term sells accordingly, and then jump in the buys when the technical price action and market structure as well as fundamentals give evidence to do so. Same thing like when you're playing this potential bearish structure and you're primarily seeing the downside moves, you don't want to be selling when you're having GJ in the way that this pair behaves in terms of the buyers and sellers transactions. You don't want to be selling during these aggressive pullback phases that can last weeks. Does that make sense to everybody? Because at the end of the day, the majority of the people who watch my stuff are scalpers and intraday traders. So yeah, anyways, in the short term, I do see that GJ is in this potential pullback phase and can come up to these potential high points before continuing back down. At the same time, individually, the Japanese yen is very flat and bearish on the higher time frames and intraday time frames. Okay. All right. Now, our US dollar pairs. Remember, we are primarily looking to play the US dollar strength. And as the world reserve currency, you can see when the dollar is so bullish on the intraday time frames, GU and EURUSD are extremely bearish and an intraday bearish market structure across the board here, right? EURUSD had a heavy drop as we saw an outflow on euro pairs across the board today, the same time we had US dollar strength. So we're going to be looking to continue that sentiment. Now, fundamentally, last week, which I forgot to include on GJ as well, another reason why we were playing the sells besides the Bank of England sentiment was that also the UK GDP data, manufacturing output data, and industrial production data was also very poor and bad. So the same fundamentals for GBP weakness are obviously applied for GBPUSD, but the even better sentiment here is that we have that GBP weakness the same time we have that individual US dollar strength we can monitor with the dollar index movement, right? So we can see overall very nice bearish market structure, potentially looking to just revisit these lows, which we have done, create this bit of a resistance, play that US dollar strength, and at least target these previous lows back to 1.335, right? So we didn't get the full pullback to 348, but that's okay. With that US dollar strength, I'm more in the overall, even if we come up to here, I'm in the seller's bias to at least target these lows. The safest sells breaking those lows, playing to make the next impulsive move and new lows being printed. Keep in mind the UK economic data we have overnight with the job figures and unemployment rate. Now, they are expecting a drop in the average weekly earnings already. They are expecting that in both the quarterly and the monthly, and they're also expecting a good decrease in unemployment rate. But I still think unemployment rate's either going to be on the same figure, maybe even a bit higher. And this data is going to be pretty lackluster, maybe give GBP a bit of a liquidity grab and pullback, but still overall continue back bearish playing the market structure. Okay. Now, EURUSD, very strong impulsive breaks below the key levels and previous lows. We can't anticipate when we're going to have a pullback phase. So I'm more just looking to see if we're just going to have continuation below 1.385 sells. If we break above 385, that intraday sell idea and scalp sell idea is invalid in the short term, but I'd still be looking for sells from 1.144 previous low and medium term retest, where we had this sell orders generated, an outflow of euro liquidity and US dollar strength in the impulsive break below there. Those are supposed to be red. Now, USD Cad is the more of the inverse of GBP USD and Euro USD, as we're looking to play that dollar strength and intraday bullish market structure being created here. I am looking first around 1.25 flat as a retest point after we had buyers extend into these new highs with that dollar strength, intraday highs printed in a potential pullback phase here, looking to collect more buy orders after reaching this demand zone and at least targeting these previous highs back to 1.26. So you can see in terms of the price action, this is roughly a 50% correction of this impulsive buyer's move here. Very strong bullish market structure and bullish price action as well, in terms of strong bullish price action candles here, minor bearish pullbacks, consecutive bullish candles. And you can see this pullback is very slow and corrective with the mix of candles, more looking like profit taking from those intraday highs, coming down to this more favorable demand zone before coming back bullish to the upside here. Right? So you can see this minor bearish structure being created here, but I'd still be looking for buys in these areas. Deeper retest at 248, but still first at 25, or break above this corrective pullback structure. All right, everybody. Biden just signed a $1 trillion infrastructure bill. Breaking news live right now. You've seen it first here during the Capital Hungry Monday market stream. More money being printed. More inflation. Crazy. No, it's not more money being printed. The money's already been printed, but still. So anyways, everybody, we went over those fundamental points. We went over the economic events you have to focus on overnight, as well as later in the week too. We did some analysis, higher time frame fundamentals and technicals on gold, GJ, GBPUSD, EURUSD, USD Cad. Oh yeah, and US30 just buys. Keep it simple. US30, just play the buys, ride the wave of the stock market buyers and of the central bank support. 36 flat, 35 850, 36 100, 36 200. Unless we have any market fear, uncertainty, or doubt, or any new fundamental catalyst for investors to price in that bring fear, uncertainty, or doubt, there's not really any reason to sell or fight against the stock market bulls or to fight against the Feds. All right. Okay, so full analysis and trade ideas given across the board for intraday and scalp trade ideas on gold, GJ, GU, EURUSD, USD Cad, and US30. Remember, I'm not a magician. I'm not a fortune teller. I'm just a guy here in my room who's studied the markets for 5 years now, economics, fundamentals, technicals, trading psychology, and so forth, and giving my 2 cents in view. At the end of the day, make sure you do your own due diligence and analysis. Make sure you follow your trading plan, risk management plan, and try your best to avoid emotional decisions. And I'll see all of you Wednesday morning for the New York scalping session at 7 a.m. Eastern. All right, everybody. Hope you guys enjoyed that. I don't want to make it too long. I just want to make it straight information and value about what's going on in the markets and how we can potentially take advantage of it. And I will see everybody on Wednesday. If you guys can do me a favor and like the stream, how many people are watching right now? If we have 100 people watching, there better at least be 100 likes. Otherwise, no New York scalping session. If not 100 likes, no New York scalping session. I'll cancel it. I know you guys miss it. 5 seconds. 5, 4, 3, 2, What? Looks like we didn't make it. Looks like we didn't make it. I'm just joking around. But anyways, I'm going to head out. I'm going to be very busy in the evening. So I'll see all you guys Wednesday morning, 7 a.m. Eastern, back on this channel.